Hey, welcome back to this 10-part series on administration. This is part 6, financial accounting, the overlooked role that protects your family's assets, how proper trust bookkeeping prevents exposure. This video clarifies how financial reporting, bookkeeping, and structural oversight protects the trust. Learn how accounting supports lawful control without ownership. Throughout this series, you've heard me say trusts are not just for the wealthy, and that trusts are for anyone who wants privacy instead of exposure. Well, a private trust without accounting is just paperwork. If your trust does not have disciplined bookkeeping, you do not have administration. You have confusion. Stay with me to the end of this lesson because most families misunderstand this role, and that misunderstanding creates unnecessary obligations. As we continue to lay the foundations for managing a private trust, I get excited thinking about slashing tax obligations by 70%. Imagine how you could spend all that money. Or can you imagine never being sued in your personal capacity? And yes, we will definitely get into the how of it all on this channel. However, this is lesson 6 of 10 and an overview on administration. So taxes will be covered in a future video. And not because I don't want to get into it right now, but would you agree one should crawl before they walk? The worst thing you can do is believe once the trust is formed and assets are transferred, the structure protects itself. That belief is incorrect. A trust is not protected by paperwork alone. Therefore, when accounting is ignored, trustees lose clarity, beneficiaries lose confidence, records become inconsistent, and external scrutiny becomes more dangerous. The opportunity here is simple. Structured accounting creates alignment, transparency, and lawful privacy. The goal of this lesson is to clarify how accounting functions inside a private trust and why it is essential for lawful administration. Not for tax avoidance. Okay, so everybody slow down for a second. Not for appearances, but for order. Under statutory systems, accounting is often treated as a regulatory compliance. Here is what that compliance looks like for, let's say, an LLC. Self-employment tax, federal income tax, state income tax. Under common law, accounting is a fiduciary duty. Here's an example of what accounting looks like in a trust. Without any planning, right now in Georgia, because that's where I'm at, only the first 13.61 million, the federal estate tax exemption in 2024, of an estate's value can be excluded from federal estate taxation. With minimal planning, using a family trust, a married couple can effectively double that exemption and pass on up to 27.22 million of their estate to their children without any federal estate taxes. Now that's going to preserve more of the estate for the family. Granted, trustees must maintain records, account for property, report activity, and preserve clarity between legal title and beneficial interest. Without accounting, the trust begins to look like personal ownership, and personal ownership equates to exposure, not privacy. I mean, some may say, to include me to some respects, our trust only earns $5,000 per month. That's small. Even a modest trust with $5,000 in money flowing in every month can require 6 to 10 hours of bookkeeping per month. That includes paying bills, recording income, processing distributions, if you set it up that way, tracking exchanges, managing deposits, generating reports. A trust holding $50,000 without accounting is weaker than a trust holding $5,000 with consistent reporting. Substance over form. Remember that. Here's where many families get confused. Trustees hold legal title. Beneficiaries hold beneficial interest. Accounting protects that separation. If trustees cannot produce profit and loss statements, balance sheets, investment tracking, or clear distribution records, then the line between legal control and personal use begins to blur. And when the line blurs, exposure grows. Control is not domination. Control is disciplined stewardship. Accounting is a core function. Accounting is not optional. It is administrative infrastructure. Once the trust checking account is funded, someone must maintain consistent financial reporting, track all asset transfers, record exchanges into the trust. Real quick, in exchange for liking this video and subscribing to the channel to help us reach our goal of 10,000 subscribers in the year 2026, the exact exchange document I will use is in the description below. You're welcome. Imagine looking forward to all the videos teaching you how to set up and manage your assets in a private trust, strategically managed by a trustee for the benefit of your beneficiaries, and you're not subscribed. Do you have commitment issues, dog? Subscribe. It's free to subscribe and hit the notification bell so YouTube cannot decide when and how you see the next video. It's free. When trustees disagree, accounting will provide the common reference point. Monthly reports are essential. Every month, the trust should generate a profit and loss statement, a balance sheet, record of distributions, record of asset additions. This is not corporate reporting. This is fiduciary clarity. Trustees must be able to answer, what does the trust own? What does it owe? What came in? What went out? What was distributed? Without hesitation, here are another one of those moments to train a responsible progeny in the accounting. A beneficiary who learns bookkeeping, understands financial flow, tracks investments, prepares reports, begins to grow into long-term administrative clarity, but you must supervise them. The bookkeeping function should be handled by someone actively involved in trust management, often an executive secretary or general manager. So administration and financial oversight remain connected. Accounting must not drift away from management. Look at these recommendations on software, because your trust is going to blow up and provide you and your family privacy, security, and confidence long after you are gone. So as activity grows, simple spreadsheets become insufficient. Administration must evolve with the complexity. When accounting is structured, trustees operate with clarity. Beneficiaries remain informed. The separation between legal title and beneficial interest stays clean. Internal disputes decreases. External scrutiny loses leverage. A trust is not protected because it exists. It is protected because it is administered. And accounting is the backbone of administration. For those who want to protect without permission, lead without being allowed, and pass on more than just money, everything here is built for clarity, privacy, and precision, so you can move forward with confidence. Since you made it this far, comment below. I do read most of the comments, and I'll see you in lesson 7 of 10, How Trust Brings the Family Together.